Hello, everybody. Tonight we will talk about non financial issues that we should consider in accepting a new client. And as you know, our case relates to ocean manufacturing, and you having been promoted as the new audit manager is going to be, in a good part, responsible for this process. So, what are the items that we need to consider? Client acceptance decision. What that means is that a new client is evaluated by the firm and individual engagement partners prior to the formal acceptance of the audit engagement. This is actually what you are going to perform right now. You are going to analyze as to whether your firm should really accept Ocean Manufacturing as your client. Client continuance decision. Now, this pertains to existing clients of yours. At one point in time, a firm may decide that it could no longer continue to provide the same audit services to the company in the future. What are the risks that are related to client acceptance and continuance? There are inherent client entity characteristics, independence risk factors, due diligence, third party risk factors, quantitative, qualitative, governance and organizational risks, and of course, financial reporting risks are to be considered as well. Why will an audit firm refuse an engagement? Well, it could be that the client profile does not align with the growth strategy of the firm. Let's say, for instance, this particular company is engaged in healthcare and your firm has no experience or background in healthcare. That could potentially be an issue. So goes the second bullet. The area of expertise is not really the focus of the firm. Let's say, for instance, this particular company manufactures widgets, and your accounting firm does not manufacture, not that it manufactures, but it does not engage in anything that deals with manufacturing, then that actually lessens the expertise of your staff and your managers. It could very well be that the client may be too big for the firm. You are a 10-person accounting firm and you are going to audit a Fortune 500. Think about how much resources it would require for you to do that. Or just simply because you can see that a client could potentially be problematic. Now, as far as discontinuing future audit services, well, sometimes over and above what I discussed earlier as characteristics of risk factors, you also have to look at recent developments. Sometimes, a change in management may make it difficult for you, the auditing firm, to rely on the representations made by the management. If, let's say, in last year's audit, records were deliberately falsified, and you know that the management has a heavy hand in the process of the audit. Things of this nature may make it very difficult for you to continue to perform due diligence in being able to render that opinion. Remember, as auditors, we are paid to render that opinion. We are not the bookkeepers of the company. We are there to render an opinion based on the evidence that they provide to us and our assessment of it. So I hope this pointers will help us further discuss this as we continue to discuss this item in our discussion board over the week. Okay? Thank you, everybody, and I look forward to all your feedback.